All right, here we go. Thank you so much. Hello there. I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. It's about personal finance, it's about investing, it's about helping you learn what you need to learn. I just want to give you some knowledge and help you make better financial decisions. That's what the show's all about. Be the Boss of Your Money. It was just a catchy name. I thought it was a catchy name, but it's really about helping you take control of your money because it's very easy for your money to take control of you or your lack of money to take control of you. So that's what we talk about. We talk about abundance. I want you to have an abundance mindset. We talk about personal finance and I'll tell you about what I did yesterday. I thought it was pretty important. I had a meeting about personal finance, but it wasn't the kind of meeting you'd expect. Ooh, kind of mysterious. So stick around. We've got to just go through some markets. I know this has been a painful time for investors. I get that. I uh, I understand it. I'm in it too. And some really poorly performing stocks are really just starting to look like they're never going to come back. So we need to get through this. We need to know what to do. We need to know our next step. So let's just roll the quick intro. We're going to talk about some personal finance items and we're going to talk about investing and we're going to talk about the two stocks of the day. While you're watching, if you don't mind, give us a thumbs up, a heart, an applause reaction, depending on which social media platform you're watching from. And if you have a favorite platform and you're not following me there, please do so. Okay, I'd love to connect with you. And what else? Leave a question in the comments if you want to know something. You have a question about what we're talking about. That's what the comments are for. I love hearing from you. It's the best part about doing this. And you can always just hit me with your favorite emoji in the comments or words of wisdom and words of encouragement. That is always welcome as well. So now we're going to roll the intro. And where's the intro? Here we go. All right, thank you. We're just getting started. A couple of things to talk about today. It's another down day. The major averages are down roughly 2.5% across the board. The Dow, the S&P, the Nasdaq. And by the way, you can't invest directly into an index, but you could invest into a fund that tracks or mimics an index. I like to say that it's almost like a reflex. It's like when I meet people at a networking event. Hi, Mitch Goldberg. How are you? Yeah, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And then I'm like, why did I just say that? It's like a force of habit. Who we have out there? We have James is out there. Hey, James, good to see you, my friend. Thank you so much for joining me. James has been a guest of mine. James is on LinkedIn. Follow him there. James is also my partner, right? And OSJ and all those other good things. So good to see you, buddy. So, what do we talk about today? So, another down day in the market. We're going to hit the two stocks that I think are the most depressing, disappointing stocks of the year. Not much to say about them except for that. One is Nvidia, with all its promise and artificial intelligence and its brilliant CEO and its must-have super high-end, super fast chips that you need for every advanced application. The stock has been a disaster. And the other one is a stock that people thought they could hide in, which is Costco, which has become just a bloody pulp. It's unbelievable how bad Costco is. I'd sold Costco a while ago, and I kicked myself thinking I'm going to regret selling Costco. I'm not regretting it now. Now my question is, when do I get into it? And then the real question is, the gist of today's show is, how do we know if the market's bottom? When will the stock market finally stop going? Because this is really bad. This is getting this is this is painful. And accounts are going down, and we're not getting any help from bonds because it used to be you'd have a portfolio with some bond exposure, some stock exposure. And if stocks went down, the bonds would at least hold up or go up a little bit in price. But now everything is going down, and it's all a matter of the reversal of Fed policy. Um, if we're going into a recession, and just follow me on this logic, if we are going into a recession, we could argue, I could easily make the case that we're in one. I think we've already begun the recession. How do you like that? But if that's the case, you would expect to see interest rates go down, not up, because when the economy slows, investors go into bonds, okay, for protection, for stability. And then interest rates go down because the economy is slowing. But that's not what's happening now. If the Fed is going to raise rates and push us into a recession, you really shouldn't see long-term rates going up. You should see them going down. Okay, so part of this is because the Federal Reserve sold $95 billion worth of bonds this month in September. So you do almost $100 billion a month to shrink their $9 trillion balance sheet. So now it's like 8.9 trillion, and that's a big thing for the Fed. So, the Fed's been buying bonds called quantitative easing to bring long-term rates down. Now they're getting rid of these bonds, and they're setting long-term rates up. Again, though, if this is what the Fed wants and they want to slow the economy down by raising rates and making it more expensive to borrow, and our whole economy runs on borrowing, then they'll succeed. They'll slow the economy down. And if the economy is slowed down enough to bring inflation down without sending us into a recession, that's called a soft landing. If we do go into a recession, then it's called a hard landing. And I think the conventional wisdom, I'm telling you, the conventional wisdom is that the Fed is willing to send us into a recession to bring inflation down, and it'll do what it has to do. And since the labor market is still very, very strong, there's nothing really holding the Federal Reserve back from slowing the economy down. It's, labor is a, there's two things for the Fed. They have a dual mandate. Keep unemployment low and keep inflation or keep prices steady. It's not actually keep inflation low. It's steady prices, low unemployment. Those are the two Fed mandates. There's nothing in the charter of the Federal Reserve that says 2% inflation has to be the target. The 2% inflation rate came out of some central bank meeting in New Zealand many years ago, believe it or not, and it's been adopted by the world as saying that's a good inflation rate where prices go up steady enough to keep an economy growing, but not too fast that it's so inflationary that it hurts consumers and businesses. Yeah, I know it gets a little all over the place, but that's the world we're in. So major averages are down today. Let's just take a look. Let's go to the boards here. So the Dow off 107. No big deal, but it was down over 500 yesterday. So no rest for the weary. But the Nasdaq down, almost 1.4%. That's a pretty significant down date in my book. The S&P down almost 1%. Not quite significant, but still. The low, the June low which is the year low for the S&P 500, because you keep hearing about that, the June low. I think we could test the June low, and you've been hearing me say this whole time since we've escaped from the June low into July and August. Now we're coming back down. I've always been consistent in saying that you never. Let me just get rid of that. You never know. Don't say we're not going to test the June low. We can. We'll have to see how things go. But make this about your own personal finance, not making your personal finance depend on whether or not we retest the June low. If we do test the June low, we'll probably be going lower because the June low was marked by lower interest rates and a less aggressive Fed. We've got higher interest rates, higher inflation, and a more aggressive Federal Reserve in terms of raising rates to tamp down inflation. So it's a different circumstance. It's actually a little tougher now for markets than June. So if we do break through the June low, my sense is we don't just hit the June low and bounce up. So people act like the June low is like some kind of floor underneath the stock market, but I don't think it is. I just think we probably trade through that and go lower. And then we have to think about repealing the entire rally since the Great Recession. And then we have to really start to question our livelihood and everything we've ever done and everything we will ever do. And then we just all get all depressed. The market goes lower. And then finally the market builds a base and it goes back up, right? That's kind of how it works. People who think that we're at a bottom and the market has to suddenly snap back, we're going to go right back up to 4,700 or 4,800 on the S&P. It's not going to be so simple. In my opinion, it's not going to. And because historically, I've been doing this for over 30 years, recoveries in the stock market to new highs are not always a simple affair. As a matter of fact, they're never a simple affair. It takes a while to get out of them, and people's psyche has to be busted so hard in order for a change to occur. Okay, investor sentiment is low, but I'm looking at a lot of quality stocks, and I think a lot of them could go lower, especially the tech stocks or high PE stocks. So let's take a look one more time here. All right, so the VIX is off a little bit. That's surprising. You see the VIX is down 0.64. When the major averages are down, you should see this be green. You should see this go up, a positive, not a negative. So if VIX is coming down a little bit, that could mean that smart money is starting to sense that we're at a near-term bottom and we're ready for a relief rally. I think all relief rallies are subject, I remain skeptical. Let's put it that way. The 10-year yield at 3.7. I mean, that's up there. Okay. Yep. That is definitely up there. So, we've been looking at a 3.3, 3.4, then a 3.5 on the 10-year. Now we're at 3.7. So that's a breakout. When the 2-year, when the 2-year hit 3.7, I was like, okay, that's it. It's going to 4, and it did. Well, now the 10-year is at 3.7, and I guess I'm going to say it's going to 4, because if yield goes to 3.7 on a bond, it usually will hit 4. So that's the direction I think we're heading in. Let's take a look at the whole bond curve, the whole bond market. Okay, the 2-year continues to be at 4.1%, 3-year over 4%, the 1-year over 4%, and the 6-month almost 4%. So you buy 6-month, 1 month, 18-month, 2-year, and 3-year treasuries, you've got yourself a nice laddered portfolio. And if rates continue to go up, at least your 6-month treasury will mature, and you could roll that over into a new bond, paying a higher yield, providing yields went even higher. And you could keep doing that when you ladder your bonds. So if you need more information about that, you're welcome to reach out to me, call me, we'll talk about that. All righty then. So let's take a look at the 2 worst disappointments of the year, in my opinion. Nvidia, see that 52-week low today, down $7 in the regular trading, 125, down from 346. So, lost almost 2/3 of its value from its high, and it's just a disaster. And the stock was one of the best ones you could own in a major tech stock. I know there were others that are down too, but Nvidia just seemed like it had so much promise from so many people. Got a comment in there. Let me see if I could find the comment here. Okay, let's okay. Not until the Fed stops tightening the money supply. Okay, so we're talking about when does the stock market stop going down? And Clifford says not until the Fed stops tightening the money supply. Well, I think by the time we acknowledge that we're in a recession, and that'll indicate that the Fed may be close to ending, or its next move could be cutting interest rates, that's when you'll start to see the market go up. In other words, the stock market typically anticipates the end of a recession. So the stock market typically will turn up before a recession is over. We can't even agree on what a recession is. Is it 2 quarters in a row of negative GDP? Because we had that, right? First and second quarter this year were negative. So therefore, it must mean that we're in a in a recession, right? But the NAB, the National Association Bureau of Economists, that's the official body that calls recessions. Nowhere in their literature or website does it say anything about 2 quarters in a row of negative GDP. It's just a general and persistent decline in economic activity is a recession. So, there's a different definition of what a recession is for everybody. But one of my favorite definitions of a recession is this: when your neighbor loses his or her job, it's a recession. When you lose your job, it's a depression. And that, I think, is a pretty good description on a personal level of how we could define recessions and depressions. Okay. So, Nvidia, major disappointment. And the other one is Costco. Costco is down after being down $6 in the regular trading, down another 11 aftermarket, so down $16, $17. All right. So Costco was 612. It's now 475. Kind of shouting distance, screaming distance from its year low. And Costco is such a great, viable, incredible company. And I look at Costco, and the dividend is nothing special, but its PE is still high. Its forward PE is still 35. It's still an expensive stock. So when you have an expensive stock that starts to go down, they could go down a lot. I mean, they could go from the 400s to the 300s to the 200s. I've seen it happen before many, many times. And this is what makes owning individual stocks, by the way, so tricky. Because owning individual stocks, stocks don't always recover, but the major averages always do. So when I say I say owning individual stocks is tricky, you know what's coming up. Owning individual stocks could be tricky. It's tricky. It's tricky. Yes. And then investors are always asking, what have you done for me lately? I don't know how I think of these things, but that's really about it. That's the show for today. Have a great night. Tomorrow's Friday. Typically don't do the live stream on Fridays unless something really crazy is happening in the stock market. So if you see me tomorrow, just know that it means that it was a really ugly day in the market. So hopefully you won't see me tomorrow. Okay. So have a very good night, and I'll see you Monday.